Good morning, everybody. Welcome to the July 2024 webinar. And it's now the second half of the year. We're past the peak of all the peak of the home buying and selling season. Still, obviously, a lot of activity to happen, but each of the numbers tends to decline, recede a little bit in the second half of the year. So what we're going to look for today is really, what we can already see for the fall, what we're going to be keeping our eyes open for, all the latest trends. We're going to dive into a bunch of cool stuff today. Before we get into the data, I have a couple of announcements. As always, if you're new to Altos and to these webinars, if you need to communicate with home buyers and sellers, or investors or people who need to understand what's happening in the market, I recommend our free ebook. That's how to use market data in your business. And so it talks about the data we talk about here, how to communicate with it, with scripts and suggestions and when to use the data and what the data means. So a lot about what I talk about here is captured in this ebook. So if you don't already have the ebook, I recommend you go grab it. There is a link in the chat. If you're not in the chat already, there's a little chat box. Go ahead and use that during the session. You'll find that Lael and Jeff from the Altos team are usually in that chat, and they will post links and they'll share with what's happening. And if I am talking about something in the data and you have a question, you can drop it there and we try to answer it on the fly. And so before we get started, one other announcement is that you may or may not have noticed that we've started shipping the pendings data. So these are the sales that are not yet closed. So each week, houses get offers and they go into contract, they're pending. And there's a ton of signal in the pendings data. I love the pendings because these are the houses that people are buying, but they're not yet sold. So the houses get an offer this week and they're in contract for a month or 40 days or something like that. And they close. Those close in, they may close in August or even September now. So there's a ton of signal for understanding the sales that are happening in the pendings data. You can get that as a Altos Premium subscriber. You have a county or more in your advanced analytics platform, which I'll show later on, the advanced analytics platform, where you can go get your pendings data for your local markets or for the county or the country all over available now. So that pendings data, you can upgrade to that if you don't already have it. And take a look in, and there's some good, we did a good video on when we like to use the pendings data, what it tells us. So check that out if you don't already have it. It's available now. Okay, let's dive into this month. There are a few questions that are bubbling around that I want to talk about today, and these are the ones that are on our minds for the second half of the year. For example, last week we had good inflation numbers, and the bond market rallied. The 10-year yield dropped and mortgage rates dropped for really the first time in a while. Mortgage rates they're now just below 7. And the question is, they've been over 7 for a lot of the year. What rate motivates buyers? When do things start changing? I'm going to take a look at a little bit of that. We're going to start with mortgage rates today. We have inventory up, and will inventory keep growing? What's that looking like? Are we going to see a lot of sellers? And if we see a lot of sellers, does that mean prices are going to fall nationally? Are there markets where prices are falling? We'll take a look at some of those. Obviously, one of the big stories of the past 2 years is how the total volume of sales has been restricted. And is there any sign of that changing, improving, especially if rates fall? And then, of course, which local markets are the leaders? And the story on which markets have been the strongest and the weakest has been pretty clear all year long, but it's starting to shift. And so we're going to dive into some of those local markets too. Before I go too much further, the webinar is recorded for all of the people who registered here. You'll get an email today when that recording is available. So it always there on our YouTube channel. That's the Altos Research YouTube channel. And again, use the chat if you want to talk all along the way. All right, let's dive into some data. So I'm starting today with a mortgage rates view. And this is a fascinating way to look at mortgage rates. You can see a year, and each dot on this little chart is a given week in the year. So there's 52 dots in each little bar. And you can see the spread of where mortgage rates ended up for that whole year. What we can see now, 2024 is on the bottom. And what we can see is that the fat part of the year where the most dots are has 2024 has been higher than 23. It's higher than 22. It's higher than it was 6 months ago. All of those things mean that consumers are still experiencing higher mortgage rates. Rates are down from May, but they're not down that much. And so what we could see is on the bottom, you can see the fat part where we've spent most of this year is spending higher rates than most of last year. And I've got the red bar for today, where you can see exactly where we are today. So what's interesting is that the little spread for last year, the 2023 spread, the stuff over 7.5, 8%, that was all in the second half of 2023. And so what we're shifting into now, we're really in a year of rates over 7%, more or less, most of the time. And so as mortgage rates drop to say 6.75 or down to 6.5, you can see if we get down to 6.5, that'll be the lowest that rates have been all year. And that will have a significant impact on buyer demand. For the folks that have been shopping at 7% or 7.25 or even 6.9%, suddenly 6.75 feels cheap. 6.5 will feel significantly better on those payments, and that's going to spur a lot of cash off the sidelines. And this is why this little distribution is why I say that 6.75 to 6.5 range, we get there and stay there, I think is going to accelerate in demand in the second half of the year. And it's just really this distribution. You can see how, as of now, rates have felt higher and higher for longer. So if we get lucky and rates continue to fall, that's going to be a shift in the story that we've been seeing in the data for the first half of the year. The first half of the year we started off looking like there was going to be some sales momentum. That has fizzled. We've had climbing inventory, and that has continued. But if rates fall notably, we could see a plateau in inventory. So this is how I look at why I believe that 6.75 to 6.5 is going to be significant. If we get below 6.5, that's going to be very significant, because you can see how we will be outside the range of where we've been all year. That will feel significantly cheaper to a lot of participants in the market. So that's one way to look at mortgage rates over the past decade. So then we'll dive into inventory. So as of right now, there are 651,000 single-family homes unsold on the market. You can see 10 years of inventory curves here. Each year spike and decline as we cycle through the year. I've highlighted last year and 2022. Last year, you could see in July, we had all the way through November of inventory climbing. And as I just mentioned, June through November of last year, interest rates were climbing, so inventory was climbing. So in 2022, which I've also highlighted here, there was a late year spike in inventory. So inventory had plateaued, and then there's a little spike starting in September because rates climbed in September of 2022 to peak in November. So you have rates climbed late in the year. We had inventory climb late in the year. Most years, you can see back here in 2019, most years inventory is flat for the late summer. July, August, September, maybe they move 1 or 0 to 1% up or down in a little week. Maybe it actually peaks late in August or September, but it's basically flat. Inventory is basically flat in previous years uh, in the late summer. So the last 2 years where inventory has been climbing late in the year has been unusual. It's been because we've had really big interest rate moves late in the year. So if we get lucky and we've finally seen the peak of interest rates, then we could see that we're perhaps around the peak. Maybe we get a little bit more of inventory gains. We'll probably get more inventory gains through the end of August into September, but not 2% or 3% per week, but more like maybe 0 to 1%. And that's what we should expect. Now, on the other hand, if rates don't fall or they jump back over 7%, you should expect inventory to keep climbing like it has in the last couple of years. And as I say, I don't forecast interest rates. I'm not sure anybody can forecast interest rates. So I don't know if rates have peaked and they are going to fall from here. It feels like we are finally there on the Fed cutting short-term rates probably in September. And the unemployment numbers are inching up. The inflation numbers are down. So like those feel like opportunities for the markets to ease interest rates for us, but I don't know. It could go the other way because, we're 2 years into more than 2 years into rising rates, and they've been higher for longer than anybody predicted. And so they could stay higher for longer still. There are 38.5% more homes on the market now unsold than a year ago. And inventory is up in every state. And in fact, let's look at the states. So here, the redder the state, the more the inventory is compared to last year. There are 5 states where inventory is now more than 2019. So 2019 is the last pre-pandemic time. So those states have stars on them here. So Texas and Florida, but also Oklahoma and Arkansas and Idaho have more inventory now than in July of 2019. And so inventory is growing in every state in the country. New York has the smallest increase over last year at only 6%. But like at Arizona, 70% more homes on the market than a year ago. So so we can see here, you can see the dark red is much more along the south. The lighter reds are in that central and northeast, but then the far northeast is has also grown. Far north New England has also grown in inventory. It's a big difference from New York. There's a couple of reasons for that. There's obviously migration patterns. There is things in Florida and Texas like tax and insurance costs that are rising dramatically. So the cost to hold homes in those places has climbed. There's also across the South, we can see that borrowers' FICO scores are lower. And as a result, across the South, they're paying more for their mortgages. So they feel that the buyers feel that purchasing power erosion much more acutely than they might in upstate New York, where you may be buying with cash from New York City. So there's that dynamic that's going on. And so, as of a month ago, none of the full states had more inventory than 2019. Some markets did, like Austin, Texas, but now we've got 5 states with more inventory than 2019. That's growing in general, but it is shifting a little bit. So there are some signals that we've maybe maxed out the inventory growth trend in Florida, and that maybe that's shifting to some of these other markets like New York, which are finally seeing some gains off the pandemic lows. All right. If we shift it around and we look at inventory versus demand, we can see take the number of new pendings each week. Those are the ones going into contract, times 4, and then divide by that inventory, we get to the months of inventory. And so we can see across the country, the same dark zone at the bottom, 3.4 months, 4 months in Louisiana, where just over a month in Ohio and Massachusetts area. But if you notice this a month ago in Ohio, it was 1.0. So increasing just a little bit in those areas. Finally, more like normalizing in some of those areas that have still very low inventory, like the pandemic lows, just barely coming off the pandemic lows. So this is months of inventory, and you can see that this is growing across the country. And it has been growing as rates have stayed higher for longer. And so, one of the questions I have is, can we watch the months of inventory plateau if we see rates notch down to, for example, below 6.75? One of the places we'll see it is we'll see demand is spurred faster than supply. So we'll see things like months of inventory will fall if we get that, if we get finally past the peak of mortgage rates. Okay, let's switch to new listings. So it was this is from a week ago. The data included the long 4th of July holiday, which was Thursday, Friday, Saturday, Sunday, and so significantly fewer new listings, but it dips every 4th of July, and you could see each line dips for the 4th of July holiday. So fewer sellers happen then. So at 57,000 new listings unsold this last week, that is fewer than a year ago. It is notably down from where it's been. It is 1 week, so it'll bounce back up in the next Monday's reporting, but it will. What the question I'm looking for here is, is there any signal that we've got more sellers coming to market? More sellers each week, a flood of people worried about their jobs, or people who can't afford their insurance payments, or whatever the things might be that would create a flood of sellers. And the answer is we don't see any flood of sellers. That means we will have a cap on inventory growth this year. And in fact, you can see, we're looking like the dark line is this year, the bright red line is last year, and the light red, the pink line, is from 2022. After July 4th of 2022, you can see a distinct drop in that pink line for the second half of the year. And that's because if you were selling in 22, you knew rates were rising, you knew you wanted to get out in June before the second half of the year. And after that, the sellers started pulling back, and you can see it in the new listings data here, that by the end of the year, we had ultra low new listings each week in 22. And that was a signal starting in July that we could have seen that the inventory growth was going to be limited because we just don't have a lot of sellers. It looks like we're in a mode right now where we're going to mirror that again this year, where it's now past the 4th of July, and we're unlikely to have a spike. And so that says to me that there is no flood of sellers. Keeps a lid on inventory, and that has implications for things like home prices for the rest of the year. If, on the other hand, rates jump again, or we get recession, you get job losses and things, something that spurs that sellers to come to the market, and we see this dark red line go into the gray zones, which is past years, and you can see they bounce around, but you might have 80,000 new listings in a given week, and we're at 65,000. You can, in those, if we were to get there, we'd assume greater inventory growth, we'd assume more negative pressure on prices, all of those things, but that's not in the data. All right, so those are the new listings unsold. Now, I also talk about the new listings, which are immediate sales. The immediate sales are those that get listed. They are the best properties at the right price. They take offers immediately, and they go into contract within days of listing. And so what I've done here is I've tracked the percentage of new listings that go into contract immediately. And you can see back in the beginning of 22, when we were coming out of the pandemic, and its mortgage rates were still in the threes, and everybody knew they were climbing. People were buying everything in sight as fast as they could. And so 35% of the listings were going into contract immediately. We were buying everything. Then in 22, that dropped really quickly as the market cooled, got down to about 15%. Last year recovered a little bit. This year has recovered much less at the right end of the chart. And right now, in the last few months, as rates have stayed higher longer than anybody, you can see how buyers have been getting discouraged, and that immediate sales percentage is down at 16%. It is significantly fewer than last year at this time. And so if mortgage rates fall from here, we will see, as I say, demand is more sensitive to rate changes than supply. So if rates fall, we won't necessarily see a flood of new listings, but we would see a pickup in immediate sales. So if rates fall, we could see this percentage turn back up at the right end of the chart. If rates rise, you can see exactly how muted home sales are going to be through the rest of the year. You can see how demand is like, it's a really interesting, easy gauge of how much demand is out there. We had that massive in 21, 22. We had a little surprising spike in like March and April of last year. Some markets like Phoenix recovered. This year, we have significantly lower gauges of demand. So it's a really interesting thing. And I'm watching for that. If we get lucky, rates drop, we're going to watch and see if this turns up. And then finally on the listing side is what we call the coming soon, the pre-listings. These are the homes that are not yet listed for sale, but they're marketed as coming soon. They don't do them in all markets. They don't, not all properties, but we can track some. And when we see them happening, we can track how many are happening. And what you can see here is in 22, that peak in April, May, June of 22, if you were selling your house in 22 and it wasn't ready to sell yet, you were trying to squeeze it out as a coming soon listing in June because you knew that by July and August, you were missing your window. As soon as July hit, the coming soons fell off a cliff in 22. And they stayed low all year last year because we had very restricted seller inventory. This year we had good growth in the coming soon, right? We had more sellers coming, but it looks like in the last few weeks, like 6 weeks, we've had a decline in those coming soon. So that implies to me it's another signal for a cap on inventory in the second half of the year. Right? We've had more sellers in the first half. We had some hopefulness, but now they're discouraged from the fact that rates have stayed higher for longer. So this is just another signal to me that says we've got some cap. We're not going to end the year with a giant spike in inventory unless we see a giant spike in mortgage rates. And therefore, here's what we're looking at. We're currently, this is a forecast for where inventory shows for the year. In this case, each line is the year, the curve of inventory. The black line in the middle is where we are. The dotted line is the forecast for the rest of the year. We expect to end the year with 620,000 single-family homes unsold on the market. That'd be about a 20% gain over last year, which is still a pretty notable gain. Right now, we're at 38%. 38% more homes on the market than a year ago, and end the year with 20% more. And that's because that compression is because inventory grew September, October, November of last year because rates spiked September, October, November of last year. So this assumes that we don't have another spike in mortgage rates. And if we don't, then we'll have a more normal curve of inventory. It'll peak later in the year and start declining for the holidays. And so we get that normal seasonal curve. And it will it'll have easier comparison over the year prior because the year prior had inventory gains in November, which are very unusual. So currently looking at about 20% inventory gains over 2023. If rates were to fall notably, like below 6.5, I bet we will actually drop this projection down. It'll start falling each week towards closer to 600,000, and it'll be really fascinating, like to measure in that total inventory forecast how the demand has shifted. If we get lucky and rates fall, we'll get more transactions. We'll buy more of the supply, and the forecast for the rest of the year will drop down. All right, let's shift into the pendings. So I mentioned the pendings data is now available for customers. So you can, in your Altos account, in the advanced analytics tab, dive in, you can upgrade to the pendings data now. And it's really great because it tells us who's buying, what they're buying, what price points are they buying? Are the transaction volumes finally going to pick up? All of those things are what we get to see in the pendings data before the sale happens. So this week, long holiday weekend, 58,000 new contracts pending. It's right about the same as where it's been in the last couple of years. And what this shows us is the dark red line is this year. And where I had some optimism for sales growth in like March and April this year, by May, now rates are still higher. And the last 8 weeks, 10 weeks, there's been essentially no growth in sales. So that momentum has gone. And it looks like we're going to finish the year on the curve, the bright red curve from last year, like about the same low level of sales that we finished fourth quarter. We've been on since the fourth quarter of 22. You could see there was a drop in October with that mortgage rate spike. And so the number of contracts started each week has been down for 2 years there. And so the question is, again, if rates fall from here, then how much do we lift off of the red line from last year? How much sales gain do we get? So as of right now, though, as I've said, it's like it's sort of darkest before the dawn. We have home sales and are not showing any real growth over last year. This is restriction on both sides. Demand, of course, is down, but in a lot of the country, that new listings volume is very low and the inventory is very low. So we still have a potential sales cap in places like Massachusetts, where demand's been pretty robust this year. Still lots of multiple offers and tight inventory, people buying what is available because there's not that much available. So that's also keeping a lid on total transactions. If we look at all of the homes in contract, we're like 1% more single family homes in contract than a year ago, 382,000. You could see significantly fewer still sales than 22, and no real liftoff. Earlier in the year, in the first and second quarter, I was hoping we would get a little bit of sales growth, but we really have lost that momentum, and we're down, maybe 1% more homes in contract than a year ago. So still on a pace of, when NAR releases their pending home sales number, their seasonally adjusted numbers, around 4 million, give or take, and we're just not lifting. There's no signal that we're lifting off of that pace at all. Days on market, the homes are taking about 9.5, 10% longer to sell this year than a year ago. In this case, each bar is a week, and the total number of days, the average number of days on market for the homes that are selling. And so, 53.5 days right now across the country. Last year, it was under 50, it was like 48. So it's taking 10% longer to sell now, significantly longer, almost twice as long as it did coming out of the pandemic in 22, but also in 22, you could see the market slowing and days on market climbed all year long. We're not in that transition either. So we're at a more stable market, but just slower demand. Let's switch to price cuts. Then we're going to do pricing, and we'll dive into the local market. So there are 38.3% of the homes on the market have taken a price cut since from the original list price. That's up 30 basis points for the week. So from 38% to 38.3. And what we're looking at here is each line is a year, and you have a normal curve for price reductions. The best fresh inventory comes in the spring, so fewer price reductions. If it sits around, they don't get their offers, they do price cuts. The normal range is about a third of homes take a price cut. So 33%, 30 to 35%. So the fact that we're at 38% is indicative of slower demand. It's also important to watch the slope of this line. If this line has a steeper climb, that means more people are cutting their prices faster. And what we can see is in 2022, a really steep climb of price cuts. We could see also in 22 and 23 price cuts that kicked up in September because those were two mortgage rate spikes. So what we're looking at now, and the theme, for July is like, are we finally past the peak of mortgage rates? And if so, if they ease down, then that means if I've been shopping for a home at 7.1% and suddenly it's 6.75%, I am more likely to make the offer. And therefore, as a seller, I'm more likely to have offers on the table. I'm less likely to do a price cut. And therefore, we would see a plateau, a late summer plateau in price cuts, like we normally would in the last time we had normal years, whenever that was. And on the other hand, if rates jump back up over 7 again, you're going to watch the price cuts. You like, if rates jump back over 7, I'm a buyer. I take a step back. I don't make the offer. The sellers then on Monday go, we didn't get the offers we want. We need to discount it to generate some demand. And so we would see an acceleration in price cuts like we have in the last 2 Septembers. That's certainly possible. As I said, I don't have any ability to predict mortgage rates. I'm just going on it like optimism right now that if we get lucky and we've passed the peak of rates and we start falling, then one of the places we'll see it in price cuts, we'll see the price cuts plateau. And that would be a stabilizing leading indicator for home sales prices for later in the year and next year. So the homes that are on the market now and don't get an offer and do a price cut in August, and they got an offer in September and they close in October, you start hearing about that in November, December, but you can really see right now where those price changes are happening. So we see looks like a slight deceleration in the price cuts, like a stabilization. So when we think about where home prices will go for the year, we could think about, we are currently in positive. Home prices are up year over year, and I'll show you that in a second. But this is one indication of mitigating but not falling home prices later in the year. So if we watch price cuts jump from here, that'd get more bearish. So moderately conservative on what this tells us about home prices in the future. Most of these years, the gray lines, these past years, these have been hot real estate markets. These have been 5, 7, 10% home price appreciation years when a third of the home sellers think they're overpriced and only 25% need to do a price cut. That's because there's more buyers than sellers, and that was driving home prices higher. So we're more cuts now than we have in any recent July, but it's not skyrocketing. Let's switch to home prices, and then we'll go to local data. The median price of all the homes on the market in the U.S. right now is $450,000. That is unchanged from last year. The home prices are actually down a fraction below where they were 2 years ago. And this is if I walk into the housing market in the US and I go to buy a house, the median price is $450,000. This is what we can choose from. And earlier in the year, it looked like we were going to get some home price gains that plateaued, and we're now unchanged from last year. We will expect it'll be about 450 for the rest of the year, and then start declining. And so, what we expect is to, if you look at the headline for price appreciation, the things like Case-Shiller index is still showing record levels. It's showing 5 to 6% home prices appreciating right now. Well, not now. It's like April over April of the previous year. And we expect, because we can see prices for the active market are flat year over year, that implies to me that the sales headlines are going to compress from 5 or 6% to 5 to 4 to 3 as we go later in the year. And we can see that because there's no increase in the asking prices, and the asking prices are before the sale happens. If we look at the pending sales prices, so the homes that are priced at the people are buying is just under $400,000 right now. And what I've mapped here is the change in pending sales prices from a year prior. So we can see over the last couple of years, in April of 22, we were still at 10, 12. Just before that, it was 15% home price appreciation in 1 year from April of 21. We saw the dramatic slowdown in 22. And then by the first quarter of 23, for the first half of 23, we were reporting negative home price changes year over year. So January through end of June of 23, those were all those negative, home prices are falling headlines. And you could see it in the data. You could also see it falling dramatically all the way through 22 on its way to negative. If we look at the right end of the chart now, we can see that we're at about 4% home price gains. So the pending sales are 4% higher than when they were a year ago, and not really compressing down like it did in 22, like not falling down. So that like maybe slightly lower. So from 5 to 6% to now 3 to 4% in a given week, or 4% in a given week. And what I expect to see on these pending sales is watching this dip below 4 into the 3s, and maybe even below 3 by the end of the year. So the next 6 months, watching the year over year home price changes go from about 3, 4, 5% down to 0 to 3%. It's not falling quickly, although you can see in June of 22 at the left end of the chart, and then again in October of 22, those were those big mortgage rate spikes. And that's when demand backed off, and you could see it directly impacting home prices in those times. So if we're in a stabilization or even improvement of mortgage rates now, it'll be fascinating to see how quickly the sales prices respond. I am not clear on how quickly that's going to happen. I have much more visibility into, inventory changes, supply and demand changes, but I don't know how quickly that translates into price changes. But as of right now, it looks like we're going to ease down into the 0 to 3% home price appreciation year. So still an up year for prices, but pretty moderate. All right, let us switch to local data now. I'm looking at the Altos platform. This is our advanced analytics platform. I have, by the way, I mentioned that Texas is one of the states that has more homes available than 2019 pre-pandemic. You can see Texas now as a state has more homes on the market than they've had for 14 years since coming out of the bubble burst. That's, I think, a significant time here. But really here, what I want to do is do our rank of our price reductions. So these are the big markets in the country ranked by how many have the most price reductions. And this tells us where demand is coolest. what's been interesting, if you've been attending these webinars in the last few months, you'll know that the Florida markets have dominated the price reductions this year. But suddenly we've got the Western US, Austin, Phoenix, Dallas, Denver are now starting to climb back into the top 10. So that is a shifting away from Florida and into those Western boom markets that are slowing down again. And so this was really a pattern of 2 years ago, 22. The slowest markets were Austin and Phoenix. Then most of this year, it's been the Florida market. So we still have, Southwest Florida, Sarasota, Tampa, Punta Gorda, all of those are, Southwest Florida markets. And so those are still at the top, but I think it's notable that the Western markets are slowing down and inventory is building, and that is also putting a cap on prices. Let's look at a few local markets while we still have some time. So I have Minneapolis open here. Minneapolis is one of these markets where, inventory is growing. And if I look, 5,000 homes now versus 4,300 last year at this time. So up 15, 18%, but still dramatically fewer, 9,000, 9,500 pre-pandemic. So a lot of the country still has inventory that is just barely coming out of the pandemic lows, but is up, significantly year over year. The median price in Minneapolis is $530,000. And if we go down and look at the price range quartiles, we can see that really any demand is strongest under 700,000 or so. And the cheaper we get in that area, the faster it moves. In the bottom quartile there, $330,000, 28 days, moving very quickly. And that will, keep a support on home prices in Minneapolis. Price decreases are only at 32%, so they're up for the last few months, but they're not dramatically high for compared to, they're up over coming out of the pandemic, but they're right about normal pre-pandemic ways for Minneapolis. And normally Minneapolis still has a few more months of a cooling market in the fall as cooling with the weather. Punta Gorda might have been, let's switch there. Florida might be the slowest market in the country this spring. We can see things like, if we look at the prices in Punta Gorda over the last few years, we can see a slide in home prices, and this is single family homes, and it does not look like it's found a bottom yet. So maybe we're bouncing along the bottom there, but it is significantly off the peak of 2 years ago and prices below where they were last year at this time. And if we look at inventory, look at that change in inventory. So, peak of bubble, 300 homes on the market in peak of pandemic boom, bubble. I don't say bubble. Now we've been at just over 2,500. And here's what I'm thinking here. So we saw climbing inventory in Punta Gorda through the beginning of the year. We're now the second quarter plateau, and we're starting to see inventory recede there. And so it could be, it's a seasonal change, and it could be that we are past the most of the flood of inventory. Right here was the flood of inventory through fourth quarter and the first quarter of this year. And so it may be that we are now shifting that story away from Southwest Florida to other parts of the country. We can see, though, that at all price ranges in Punta Gorda, significantly longer days on market, right? So demand is definitely down, but what this indicates is maybe we have a lid on the sellers each week, so we don't have too many more sellers flooding the market, and maybe we're at an inflection point in that story. Let's look at San Antonio, because San Antonio is one of the weaker markets in the country. Lots more inventory in San Antonio, from 2,500 homes on the market to 13,000 now. Like, that's a big deal in the last 3 years. It's also more than significantly more than pre-pandemic. So San Antonio has had a ton of new construction. It had a lot of boomtown immigration that slowed way down. San Antonio is a secondary market to like Austin and Houston. So you can see how it cascades further there. And if we look at price changes for San Antonio, we can see that we are off the peak of 2 years ago. And maybe while we're at the seasonal decline, we're maybe not yet found a bottom for prices in San Antonio. I think that's worth watching, especially, as if we get in this mode of declining rates, does that help put a floor on prices and inventory in San Antonio, or are we not yet found there? I think that's significantly important to pay attention to. I mentioned that Denver was one of the Western markets that's now creeping back into the price reductions lead. And Denver has the same amount of homes on the market now as pre-pandemic, right? So Denver is now back there. Colorado as a whole still has fewer homes than 2019, but it's getting close because Denver dominates Colorado. And we'll see if we are past the seasonal peak there for inventory in Colorado. The price reductions are on their way up, more price reductions than last year at this time. So 48% versus 42, 43. In 22, look at this real steep climb. This was, people were cutting their prices quickly and peaked at over 60% of the market with price reductions in the fall of 22. And remember, that led to sales price declines in the spring of 23. So there was like a 2, 3, 4, 5, 6 month lead time. We're not there yet, and we may be at a plateau. It'll be fascinating to watch price reductions in Denver in the coming weeks. I'm going to do Atlanta, and then we'll just wrap up. So Atlanta is a much more stable market than some of these others that I've been talking about. Atlanta has median price at $440,000 is like right at the median price for the country. It is flat from last year, which is exactly the same as the rest of the country. We can see inventory-wise, Atlanta is up from last year, so 10,000 to 15,000, so almost 50% inventory increase over last year. But Atlanta is still significantly restricted compared to pre-pandemic. So Atlanta is sort of like the whole country in a smaller market, like a most representative of the whole country. Inventory is restricted enough that we are in a seller's advantage still because there's just not that many homes for sale. We can also see in Atlanta the price ranges, the days on market at any price range under $1 million is still moving pretty quickly. The cheapest in the Atlanta metro are older homes, smaller homes, and so therefore take a little bit longer than the mid-range, which is where the optimal demand is. Okay, so that's a quick share on the local markets. Let me switch back to our slides here. And just to recap, all of the data that I'm talking about here, your buyers and sellers are probably not following along this closely. A lot of them have dramatically bad impressions about the housing market. Like, you can imagine if you're in Atlanta, there are people in Atlanta who think that the housing market is crashing, and I'm a buyer and I'm just going to wait till home prices crash. And we can say that, like, how long are you going to wait? So we have this ebook that helps you talk about the data with your buyers and sellers. I recommend you go grab it. If you don't, there's a link in the chat that they'll post a link in the chat that you can click through to go download it, or just go to the Altos Research website and find the link for the free ebook and go grab that. I think it's really useful. And I also mentioned that the pendings data is now available for Altos customers in your advanced analytics tab. So go to advanced analytics, you can upgrade to pendings there, and that will allow you to do the show. Here's what's selling. Here's how quickly things are selling. We can tell that we know this is what's on the market and this is what people are buying. And oh, by the way, if you want to make an offer, this is the highest demand part of the market. So you need to make the right offer now. Like, using that pendings data is very powerful because these are the homes that are selling, but they're not yet sold. So it's the fastest indicator of what's selling. So that's now available in your Altos account. As always, folks, I appreciate your time. I will stick around in the chat. We'll try to make sure all the questions are answered in the chat. The webinar is recorded and will be in your inbox later today. It's available on our YouTube channel. So thank you so much, and we will see you again soon, everybody.